You're welcome to week 5 of our Forex trading school. Last week, we were able to look at two important concepts in the financial market. The first being how you can master candlesticks without cramming them. That is, how you can read price action by looking at your charts so that you can know what the market makers are doing, whether investors has pushed in money or not. And the second being how you can apply the economic concept of product life cycle in the financial market to help you make wise investment decisions. And after these classes, I got some questions regarding the concept of product life cycle, which the week 5 lesson is going to tackle. All right. And these questions that I got has to do with how do I apply the concept of product life cycle in pairs like gold, euro, USD, and others. All right. I understand that last week I looked at the concept of product life cycle based on people who are making investments that they want to grow over time, just like passive income. The question should be, if I am going to be a full-time trader, how do I apply this concept of product life cycle in my daily trading, maybe as a day trader or as a swing trader? All right. This week, I'm going to be teaching us a similar concept that will help swing traders and day traders to apply the concept of product life cycle. In this week, we're going to be looking at three major lessons. The first lesson we're going to be looking at is understanding market structure in Forex trading. Market structure is just similar to product life cycle, but in this case, we're now going to be applying it how swing traders and day traders are going to be using it in their trading to maximize profit of small moves in the financial market rather than waiting for years before they can take their profits. All right, what is market structure? Just as we say, when group of cars come together, we call them fleet of cars. When group of sheep come together, we call them flock. The same way, when group of candles come together, we call it what? Market structure. When group of candlesticks, price action representation, when they come together, we call them what? Market structure. That is to say, market structure is simply the pattern of the group of candles that represent price of assets of your interest. I'm going to be using a diagram to demonstrate market structure for you, all right? Being the classification of market structure. The classification of market structure. Now, some persons believe that in the Forex market that we have what we call programmed patterns that market moves. Why do they believe that? Because when you backtest, that is, when you look at the chart from years back up to date, you will see patterns that keep repeating in the financial market. Some persons now believe that actually this financial market has been programmed to run in a particular manner. All right. This can be true because of what the repeated pattern we can see. All right. But we're not here to prove if it is true or not. I'm just going to show you what you see all the times in the financial market. Please, this week's lessons are very, very important. After this week, you will be able to make decisions. You'll be able to start trading, even though not as a professional yet. After the 3 lessons today, you can handle trading semi-professionally. So please pay close attention. Now, The classification of market structure is what I'm going to be treating in this lesson 1. And there are 4 classifications of the market structure. Now, the first one is accumulation. The second one is advancement. The third one is distribution. All these are big grammars. I'm going to use diagram to demonstrate them, and then you will understand. And the last one is declining. Okay, so let me use diagram to demonstrate this. All right, so this is the diagram of the classification of market structure. The first diagram you see here is the stage of accumulation. What are we accumulating? Accumulation of orders. This stage here is the advancement, and this here is what we call distribution phase, and then this is what we call decline. All right, you remember our product life cycle last week. We have the introduction, we have the growth. Now this accumulation as in product life cycle comprises of growth and introduction in product life cycle. All right, they are very similar concept. All right, the advancement stage comprises of the maturity in product life cycle, and then this distribution is when decline is ready, and then decline stage as we saw in product life cycle. All right, but this is how it works. In the accumulation phase, that is accumulation of orders, it means that what for that very asset, financial asset, investors are still pulling their money together at this phase of accumulation. That whenever you see this kind of movement, I want you to understand it in a real life situation. That what is actually happening behind the scene is that what investors are pushing in money, they are showing in interest, and the moment they have pushed in enough money to push this market up, you will experience a breakout of this range. All right, this is like a range. You will see a breakout, and this breakout is what we call advancement stage. You will see this repeat over and over on your chart of any pair at all, right? You will see them now push the market. We say that is what expansion. And when they have pushed the market, you will see what again will start ranging again. Market will start ranging again, and at this point we call it distribution. What is happening is this. Remember, I told you last week that the reason why any investor is pushing in money into any financial asset is to make money. When they have advanced, what do you think will happen? They will start distributing their orders, that is taking their profits. Now, when they take their profits, remember, the money of the market makers are like what? The leg of a table. When they pull out the legs, what happens? Collapse, which is what we call decline. All right? Decline happens, and then that cycle continues. They decline, and when they are declining, we say what? We are placing sell orders. Sell is going to happen. There's going to be a crash. During advancement, what do? We place buy orders. This is simply how the market is structured to run, right? Again, I repeat, we have accumulation of orders, and during the accumulation of orders, what we do is we are waiting for what we are looking out for buy entry. We are going to go into detail how you do this, right? And then when advancement happens, all right, that is what we say that there's a boom, right? People are making money, and the next thing, distribution starts. That is, there is no more enough power to push market upwards, so distribution starts. People are taking their profits, and the next thing is what? A decline. And after a decline, we go back to accumulation again, and after accumulation, we go to advancement. This is what keeps happening and happening in the financial market in different time frames. All right, we are coming down to break it down to your own time frame where you are trading as a day trader or swing trader. This is simply the classification of the market structure. All right. Now I'm going to move over to lesson 2. And this lesson 2 is now going to break it down to answer the question that you asked on the YouTube channel.